Yes, Gina.
Would you like to go first? One
Yes.
sentence, one line.
One sentence, you have to describe your business.
Yeah, there is one-stop solutions for farmers right from pre to post-harvest operations, including financial services.
Thank you.
Anita from DG Subita. Hello, can you hear me?
Yeah, Anita, go ahead.
Yeah, we are a mobile application for small kirana shops for various services, especially in rural areas.
Okay. Thanks.
Sahil, would you like to go next?
Yeah, sure. I'm from Silver. Silver is an insights and experts network for SMEs.
Okay. Awesome. Gina will start then. So, yeah, hi. So this is
Hi.
Amitabh Shrivastava. I'm partner with the Iron Fund, with the July Ventures, with Iron Fund. I seem to be living in my past. Sorry about that. So I'm with July Ventures. I used to be part of the Iron Fund. That was some time ago. Last 4 years, I have been, involved with July Ventures. And maybe I'll share a few things about myself. Let me just share my screen. Can you enable screen sharing for me, please?
Anshu?
No, host disabled participant screen sharing. So you'll have to enable screen sharing.
Anshu, can you enable the screen sharing? You are the host now, I think you can do that.
Let me know if you can see my screen.
Yeah.
That's my profile. It's all blank. Okay, here we go. So, I guess I started my career in the corporate world. I'm a graduate from BJTI Bombay, mechanical engineer. Started my career with the corporate world, and I worked with companies like Infosys, Canway, IS Infotech. Prior to that, I was with Tata Burrows, which became Tata Unisys, and another engineering company called Don Oliver. Very quickly, I realized that I wasn't cut out to be a corporate junkie, so I became an entrepreneur, started a few companies, got lucky in some of them, and then became an investor. First as an angel investor in 2008, and then I joined the Iron Fund. And since then, I've done about 19 odd investments as an institutional investor, and as an angel investor, I've done about 16 investments. I also have a lot of interest in pure sciences, not engineering, just pure sciences. And I've been involved with few companies which essentially did technology transfer and also started a India Science Venture Fund. Unfortunately, the fund didn't do well, but I did attempt to start my first fund somewhere around 2013 or so. Yeah, and I've been involved with a few policy groups, again on science, and been an IC member for an NRDC fund. So that's essentially my background. And now I will begin with my presentation. Okay, so this is what I do. I may not always be right, and the way I'm doing it may not be the only way to do things in life about raising capital or about investing. Since you guys are here about raising capital, you need to, I'll share a few tips from my life, having been involved with investing for such a long time. I've had a few learnings, and I thought that I could summarize all of that by saying that beauty is in the eye of the beholder. Okay. what good is beauty if there's no beholder? Anybody wants to take a stab at answering this question? Do you think, is there any, can you have beauty without a beholder? Yeah, I mean, you could, but you just don't know that, right? So let me ask you another question. You see two people in front of you. One is about to start painting. The other person has already started painting. And if you were to pay upfront money to say that I'm going to probably invest in this painting, which one would you choose and why? Team Silver, you want to answer it?
So work in progress would be the choice. Probably we need to get more strong conviction, right, before investing. So I would wait for another couple of months to invest.
Yeah. Are there any exceptions to that, Anita?
Yes, I would like to start with the blank canvas because the picture might be my perspective might be different because the picture they are drawing may not be my choice. So a blank canvas can be converted.
So Anita, the question is that there are two painters. One of them
Okay.
has started painting, the other has started painting, and if you were to choose which
No,
painter,
it depends upon the painting what means what he is going to paint. Means for example,
No. He says he's going to
I would-
paint something beautiful, but hasn't proven anything.
are both are going to paint the same thing?
Okay.
That is my question. If both are going to paint the same thing, we will go with the work in progress. I will go with the work in progress. But if both are going to do a different, then with the blank, my option will be the blank one.
Okay. There's no right answer. There's no wrong answer. So,
Yes, it's all about the perspective.
yeah,
If
because
the
beauty is
blank
in the eye of
canvas
the
is
person, right?
if the blank canvas, the painter is renowned, there could be a shot at the blank canvas. Otherwise, the work in progress.
Okay. See at the bottom of the screen now.
Yes, betting on founder. Yeah.
Yeah. So, which one of you is MF Hussain?
We would like to
In the
believe that
process,
we all are.
Amitabh.
Awesome. Awesome. Yes, Payal, you want to say something?
I'm saying we all would like to believe that we are all MF Hussain or Picasso for that matter.
Absolutely. And it's a good idea to make sure that the person who's about to buy a painting agrees with you.
Yeah.
Yeah. So let's figure out how can we get the beholder to admire and appreciate the beauty. So this whole presentation is about that. Anyway, so lots of popular sources of funding. Everything on the left-hand side is usually debt, and everything on the right-hand side is usually equity. Yeah. So the difference between the two is that on the right-hand side, people tend to take a risk without having much collateral in their hand. Yeah. So, but the people on the left usually will want some collateral. And you need to see when do you want to use what kind of fund for your business. Yeah. So as we go along, we will talk about when you need to raise what kind of, and from what kind of instrument should you raise the money? Should it be a debt instrument or should it be an equity instrument? Okay, so let's say an angel investor wants to invest 250K. I haven't put any currency on it, just put 250K, could be any currency, yeah, for a 25% stake. So what does it mean in terms of valuation? Payal, you wanna take a shot?
No, can you repeat the last part of it?
So if you see the screen, it says an angel has agreed to invest 250K for 25% stake. So what does it mean in terms of valuation of the company?
It's 100K. Sorry, not
1,000K.
100K, 1000K.
1,000K. Yeah.
Yeah.
Anybody disagrees with that? Balaji, you agree with that?
No, Payal is right. 10 lakhs.
Yeah, correct. Yeah, whatever that number is. Yeah, so it's about 1 million, if you can say. Yeah, million is 10 lakhs, right?
Yeah.
Yeah.
Let's picture this 10 lakhs or 1 million, whatever you call it. Yeah. So this whole circle has become 1 million because the investor invested 250K for 25%, 1/4 of the circle, right? But 1 second before the circle becomes full, what is the perceived value of the company? This green. Balaji, the whole thing is 1 million. This quarter, can you see my arrow, by the way? I'm moving my arrow on the screen. Are you able to see the arrow on my screen? Balaji?
Yes,
Okay.
yes, I can see.
We are talking.
So you see this 1/4 is 250K. Therefore, this green color must be what?
Pre-money.
Minus, yeah, pre-money, that is.
Correct, correct. And what is that amount?
750K.
Yeah, it says on the screen.
Yep.
Right? Okay, okay. So basically what we are saying is 750K, which is the pre-money, plus 250K, which is the money, is equal to post-money. 1,000K or 1 million, right? Mathematics, everybody agrees? Yeah.
Yes.
I can assure you that investing is only your 7th and 8th standard mathematics. Okay. So it's very simple. 250K is equal to 25%. Therefore, 75% is equal to 750K. That's it. Simple. Yeah. So what should you prove? Let's go back to this slide. Yeah. So how do we know that this person is a likelihood to be an MF Hussain? How do we know that? What should the story of that person sound? What should the story of that person be worth? Let me ask that question.
If it is MFSN, then the valuation will be steep high. If it is not there, then the investors can go on the CCD, certain percentage, with certain tenure, maybe 18 months or something.
Okay.
Compulsory convertible debt.
What should be the value of the presentation that they make? What should come
No,
out?
no, that's the reason we are not able to distinguish the valuation. That's the reason I'm suggesting let's go with the CCD.
I understand that. I'm saying that let's say this is a price round. Yeah. Everybody is convinced. What should the story sound like? What is the worth of the story? The worth of the story is 750K. Your entire focus should be on proving that your company is worth 750K if it is a price round. Do you agree with that, Anita? Payal?
Yes, yes.
Yeah.
Yes.
Okay. So when you tell a story, sometimes you bullshit, sometimes you tell the facts, right? So you have tangible story and you have intangible story, but the sum total of tangible plus intangible must be worth 750K. Yeah. So when your customers say that you are good, that's tangible because you can go and verify. Am I right? Yeah. So let's say the part of your tangible story is almost 70% and intangible bullshit that you're giving to the investor is 30%. It's kind of okay. Would you be okay? Is that okay? Okay, fine. What is the, somebody needs to mute themselves. Okay, so the 5 things that investors dive into to decide whether this is worth investing, and if it is worth investing, what is the worth of that company, are obviously team, market, the product or the solution to the problem in the market that they're trying to solve, what have you achieved till date, traction, and what are the possible exits for the investor, not for you. For you, you may like to run the business forever. Yeah, but you're taking money from an investor without giving any collateral, then you have an obligation to give that person a return. Sahil, does that make sense?
Yes, it does. It's fitting.
Yeah.
Yes.
So when the investor is an angel investor, you can be a little easy in terms of what the investor may expect from you. But when you're going to an institutional investor, which means that the institution has raised money from somebody else and is agreeing to put money into your company, when that happens, you need to be very, very careful about how you present your story to make its worth sound 750K, like the example that we took earlier. That was 750K. So you need to be seen as worth that much. So let's deep dive into each of these. Okay. So one of the questions that the investor will ask is this the right team to execute the plan and get me an exit? Yeah, fair enough.
Right.
How well have they studied the market, the problem in the market, the competition, and is the market growing or is it a stagnant market? Yeah. So you need to have a look at, if you notice, these are arrows which are pointing to each other. So does the team know the market? Is the team capable of creating the right product? Is this team going to deliver on the traction that they are promising? Yeah, all the future that they are promising. And are they capable of creating something which will result in an exit for the investor? How savvy they are about investor relationship. Okay. So we said market is study of the market, the problem, the competition, growth, headroom for growth. If you don't understand something, please ask me. Please stop me and ask me. If there's a term which you don't understand, please ask me. So, solution to a problem. So you have the problem which you're trying to solve. What's the solution to the problem? Do you have any intellectual property on it? Yeah. Is there any moat in the business? Do you understand what a moat is? If you don't understand, sorry, if you don't understand what moat is, please ask me. Otherwise, I'll move on. Okay.
So please explain.
Sorry.
Please explain, sir, moat.
So moat means barrier to entry. Let me show you the picture of a moat. Let's see.
It's something like a blue ocean as well as a red ocean.
Oh, just take a look at this picture. You see this picture. Hold on. You see a castle on the screen. Do you see a castle on the screen?
Yes.
Yeah. And the water body around it. Why do they put water body around it and they put crocodiles in it? Why?
Barrier,
So that the enemy
obstacle.
cannot
Nobody
Yeah.
should enter.
Barrier to entry. Barrier to entry. Okay. So that's called a moat. So for your competition, how will you create barrier to entry? Yeah. Sometimes you will create barrier to entry by land grabbing. That means you will go and acquire more and more markets, many, many customers. Sometimes you create a moat by creating an intellectual property and patenting it. So there are different ways in which you can do all of that. Clear? That's called creating a moat. Yeah. Also, your pricing strategy. Sometimes what people do is they'll launch, their product will make it free. And then after 1 year, they'll try to convert it into a price round. Sometimes you're successful in what you're trying to do, and sometimes you're not. What's your channel to the market? How are you going to go to the market? What are the means by which you will go to the market? And when will you launch which feature of your product? Yeah. Or your offering, if it's a physical asset. I come to traction and commercials. If you notice, I put traction and commercials together because in some ways, traction determines what the valuation of your company is and what kind of rights you will give to the incoming investor. Yeah. So traction of KPIs. If you don't understand what are KPIs, please ask me a question. Okay. So I assume all of you understand. How good are your unit economics? Are you profitable at the unit sale level? And what are the terms of investment? All these are important criteria to look at before the investor decides to invest. And last but not the least, is there sufficient conviction of an IRR upon the event of exit for the investors? Do you understand what an IRR is? Sorry. If you don't understand what an IRR is, please ask me a question. Okay, I assume that all of you understand IRR. All right, so I'll still take a shot at explaining what IRR is. So let's say you've taken money from an investor and you created a post-money valuation of $1 million. And in 18 months, you've increased the valuation of the company from 1 million to say 2 million. Yeah. Or if you have increased your valuation from 1 million to 5 million in 18 months, which one is better? Sahil? If my company today is worth post money of 1 million and in 18 months, my company is worth 2 million, is that better or my company is worth 5 million? Which one is better?
5 million, certainly.
5 million, because the IRR is high, right? So I'm deliberately going a bit slow on the concepts that you already know so that you begin to sort of digest what is it that the investor will look at and ultimately decide to invest some money and hold a particular percentage in your company. Yeah. Okay. Now, how much time do you think is fair for somebody to invest money in your company? Should they take 15 days to invest in your company? Obviously, you'll want them to invest immediately, right? Yeah. But what happens is I'll share
No,
something.
it totally depends. It totally depends, Amitabh. Like, if at all, it has got like certain parameters, right? If it is a business is already doing well, has a traction, and also the founder, it's generally investors bet on the founders, right? And it should have a market size as well. If all this and of course, if it has got the social impact, there are certain criterias, right, for the investors to invest. If it is meeting all those criterias, right, then it should not take more than 2 months to 3 months for them to take a decision.
Correct.
Right. If
Absolutely.
one of the parameters or something else is missing, definitely investors will give the feedback to the founder stating that these all the gaps are there, try to fill in, right? They give some time. So we have to keep updating to the investors.
What is the technical term for that? It's called conditions precedent.
You're not audible, Amitabh, we have to be a little louder.
It's
What
called
all?
conditions precedent. Am I audible now?
Yes. Yes, conditions, yes.
It's called conditions precedent, which means you have to meet these criteria before I decide to invest in your company.
Correct.
And is there something called as conditions subsequent? Do you know of something called as conditions subsequent?
Oh, no, I don't know. Probably if you can explain, it'll be good.
Yes. So what you do is, all of you, please make a note of this. Study the term sheets. What is a term sheet and what are the key terms in a term sheet? And also study shareholders agreement or share purchase agreement. Yeah. So both of these you must read. And best way to is to go to YouTube and ask the question. So somebody will actually visually describe to you what these are. Yeah. We'll try and attempt and do some of those today because you must understand every terminology that the investor is familiar with. You must understand. Yeah. How many of you have not formed their company as a private limited company, or all of you are a private limited company?
Yes.
Amitabh, sorry to interrupt. Can you allow Payal in the meeting? She's in the waiting room. I think she.
Oh, sorry.
Yeah, that's right.
Hi, Payal. Sorry, I was the person who was supposed to let you in, but I couldn't. Yeah. Payal, were you there in the discussion from the beginning, or you missed out something?
No, so sorry, my laptop went in a Sunday mode. So
Okay.
I was on this slide when it just came up, but missed the part. It's okay. You continue. I will try and.
No. So let me just quickly. AJJ has entered the waiting room. Let me admit AJJ. Hey, AJJ. Can you say a few words about your business in one sentence?
He's connecting to your audio.
Hey, Ajay, are you speaking? You're on mute, I think.
He's still connecting to audio, Amitabh.
Okay.
Abhishek, is that you?
Abhishek, can you unmute yourself? It's important that you hear the basics of
Sure.
Abhishek. Can you say one sentence about your business? One sentence.
So we are into the subsidy consulting business that we are automizing everything, from identification and ultimately navigating to get the government benefits from for the businesses.
Okay. Okay. Payal, did you introduce yourself in one sentence?
No, I didn't. So, I'm the founder of FunGrow, and it's a teen lancing platform to give them the earning opportunity based on their skills.
Okay. What I'll do is I will have to repeat quickly something that I had shared with all of the other folks. By the way, this presentation is available on my from my LinkedIn profile. Okay. So both Payal and Abhishek, for your benefit, and can you see my screen?
Yeah. So
If you
I was part of this part thing.
So Abhishek,
Yeah.
an angel invests 250K for 25% stake. So what's the post-money valuation?
Sorry, I'm not getting you.
Can you read the question on the screen?
Okay.
What's the valuation of the company? 25% is equal to 250K. Therefore, 100% is equal to
10.
1,000K.
Yeah.
Right?
Yes.
So if it is worth 1,000K, if this whole circle is now worth 1,000K, in which the investor has put in 250K, that means the pre-money must be 750K. 1,000
Correct.
minus 250, right? Say yes if you agree.
Yes.
Okay. So what should your story sound? If the story should be worth how much, Abhishek? Should it be worth 1 million or should it be worth 750K?
750K. It's worth.
And if your story has 70% tangible, that means I can verify, and 30% that I cannot verify, then it's kind of okay. 80-20, 90-10 is okay. But if you say 60-40, then something is wrong. Yeah, if you're 50-50, that's kind of a problem. So, an investor, if you look at the title of the screen, it says 5 things that the investors deep dive into are: who's the team, how well do they know the market, and what kind of a solution to the problem in the market are they trying to create, what's their current traction, what's their future projections, and what are the terms of investment, and last but not the least, what are the exit opportunities for investors. Because you're taking money from an investor, you are and they've not asked you for any collateral, right? They've not asked your house to be mortgaged to them or their your jewelries to be mortgaged. None of that. So you have an obligation to return the money, and they have to believe that that is the case. So first, they will assess whether this is the right team to execute the plan and get me an exit. How well have they studied the market, the competition in the market, and is there headroom for growth? How good is the solution to the problem? What is their pricing strategy? What is their go-to market? And when are they launching which part of the product? Then you look at numbers, the traction of KPIs. You understand what a KPI is? If you don't, Abhishek, you need to answer the question.
Key performance indicators.
Yeah, thank you. And is there sufficient conviction of IRR upon exit for investors? Yeah, so these are the 5 things. And the investors take anything between 7 to 10 meetings to decide. About 30 to 40 emails are exchanged, and maybe 70 to 80 WhatsApp messages are exchanged. So it can take anything from 45 days to sometimes even 6 months. And why does it take 6 months? Because if something is, for example, if you have not filed your returns, your tax returns, so if you have not filed your your company obligation, company law obligations, you're not been keeping track of your board meetings, not having the minutes of the board meeting, then the investor will say, first, you create all of those and pay the penalty or whatever that penalty might be, then come to us. So that's called as conditions precedent. You agree with that, Abhishek? Is there something new that I'm telling you?
Agree.
Yeah. So all of you,
Yeah.
you get back, make sure that you go through a list of things that the diligence team of the investor will look at, and make sure that all of those conditions have been fulfilled. Otherwise, you will not be able to have your company invested by the investors. Okay.
Amitabh, could I just
Sir. Yes,
get a clarity on the timeline which you expressed and the communications? Is the same for angel investors and institutional investors?
No. Angels may take far less time. Sometimes angels can be very, very sticky. Okay, so they can ask you a lot of questions. If they are experienced investors, they may get into a lot more details because they know that somewhere down the line you will run into problems. Okay, so sometimes, but usually angels will look at the founder and kind of say, "Hey, this looks good." Yeah, they will try and study a little bit, like look at the demo of the product that you're trying to create, or look at if it's a manufacturing thing, if it's an instrument or a medical device, then they'll kind of want to look at it, get it verified by some third party or whatever, and then they will go ahead. Yeah.
Thank you.
So I've put some dependencies on the screen, valuation dependencies. Anything which is a question mark here for you? Self-explanatory? All right, I'll move on. All right, let's look at KPIs because it's very hard to value a company on the basis of your balance sheet. An early stage company with very less track record, it's really hard to do any kind of valuation on the company. Okay. So I'm assuming all of you have driven cars or are familiar with the dashboard of a car. Yeah. Why does the dashboard of the car not show, say, the brake paddle? How bad a condition the brake paddle is, or how bad a condition the spark plug is? Why does the dashboard not show that? Why does it only show RPM? It'll show mileage run, it'll show gas level, it'll show oil level, it'll show at what speed you're running, and so on and so forth.
Because these are the things which are required as a user to be aware of at any point in time.
Correct. Yeah. And then depending on the purpose for which you're driving the car, on that day, you will pay attention to a particular part of the dashboard. So if you're running out of gas, yeah, so you'll immediately switch off your AC. You'll watch how low the thing is going. You'll not race too much. Your RPM will not be very, very high, and so on and so forth, right? So similarly, in business, depending on the stage of the business and the crisis that you're facing or not facing, you will either press the gas pedal or go slow. You take business decisions based upon the condition in which your company is. And the investors will also look at the same KPIs that you are monitoring and then say, okay, based on this particular KPI, I will apply some market multiple. Yeah. So for example, when you buy a house in a particular area, there are two things that determine the value of the property. One is the square footage of the house or the apartment that you're trying to buy, and the other is the market rate. Yeah. Am I right? So similarly, what an investor will do is look at the key performance indicators of your business and apply some market multiples. Now, how will they get this market multiple? From where? Can you guess?
Competition, if any.
Yeah. Good answer. Anything else?
Scope, scale.
Yeah. Yeah. All those are good answers. Balaji, you want to say something?
So if it is a project like SaaS or fintech, right, it might be valued at 1 million even at the early stage.
Yeah. Yeah. So there are many market multiples, but how do people know all this? What multiple to apply? Where is the market multiple coming from? Is there a book? Is there a
If it
yellow
is
page?
no, if it is already created, maybe in some other country, that might be giving some kind of an idea for the investors to go ahead, maybe similar business model like SaaS. If it is the first time they are creating, then it's totally just in time. They'll arrive at some valuation, thinking in the future, thinking that in the future, the particular product might be valued at certain.
I think Abhishek needs to be admitted again.
Yeah, can you please allow me, because I'm connecting through my desktop. Previously, I joined from mobile, that's why.
Yeah, Abhishek.
Thank you, thank you.
Okay. All right. So basically, there are many means. There are some paid subscriptions to a particular kind of a database where information regarding a company having raised money from some investor gets published. Of course, it's not very reliable. You have to trust that the person has provided the right information. But the analysts in such companies which are providing this information about the valuation multiples, they do a lot of homework to essentially get this information. Yeah. So you can do a Google on the kinds of, I don't want to name any of those companies here, but you can do a Google on what kind of companies publish investment data about early stage companies. Also, there is another way. You know, in a fund, there are partners and there are analysts and there are principals, right? So what happens is a lot of the times the analysts have their classmates working for a competing venture capital fund. So they'll call them up in private and ask them, hey, how much was the company valued at? And what was the KPI at that point in time? So you can get a lot of informal ways of getting information as well. Just like your formal ways, you can also have informal ways of getting the information. Okay, enough about KPIs. So what are the things that we talked about? We talked about beauty is in the eye of the beholder. We talked about pre-money being an absolute important thing to prove in order to say that I'm worth so much. So your story should be worth the pre-money. We talked about valuation. We talked about the 5 things that the investors look at and how much time do they take. And we are now talking about KPIs. Okay, because a multiple of the KPI is where though your valuation will come from. Now, sometimes the KPIs are not clear or if they are not reliable. At that point, if you still believe that the 5 parameters in general hold good, then you will do what Balaji said was, you will do a convertible route. Yeah, which means we can't fix the valuation of the company. So let's do a future analysis, look at the future scenario of the company being invested in by another investor, say 18 to 24 months from now. And if they value the company at this, then I, as an investor, will get a discount of XYZ on that valuation. Is anybody not clear? All of you understand discount?
Yeah.
Yeah. Okay, great. Right, so let's look at all the kinds of KPIs. There are many, many KPIs. If you look at the screen, you see all kinds of KPIs. But all of them are bunched into 4 major categories, which are there at the top of the screen. So financial KPIs, customer stickiness or loyalty KPIs, efficiency of capital use, and the growth and the scale. I think Payal talked about scaling up. So that's scaling. And the barriers to entry of the competition. Maybe intellectual property, it could be anything else. Yeah. So all these are examples. What I'll do is I'll take one example right now. I'll take this monthly or annual recurring revenue rate as a multiple of your business. Yeah. So let's take an example. All right. First things first. If somebody throws a chart at you, a table at you, don't pay attention to the middle of the screen. Pay attention to the names of the row and the names of the column. Yeah. So let me see. Abhishek, can you tell me the names of the column that you see on the screen?
First ARR,
Yeah.
raise
Then
amount,
raise money.
yeah,
Then
then
pre-money
pre-money,
valuation.
yes, then multiple.
And then pre-money divided by ARR is equal to the multiple, market multiple. Right? So that's how you arrive at the name, the names of the columns and the names of the rows. The rows are 1 year ago, today, and future. So I've taken a random example that today somebody is doing 1.2 crores in revenue, which means per month they are doing approximately 10 lakhs. Right? They are raising 3.5 crores on a pre-money of 10.5. Right? So 10.5 divided by 1.2 is equal to 8.75. Is something not clear in this? Anita, Sahil, Balaji?
So no, it's good. We are good.
Yeah? All right. Awesome. Awesome. But is 8.75 the right multiple? How do we know that this multiple? Somebody will say, hey, this multiple seems to be too high. Maybe your pre-money should be less. Right? So for that purpose, what Anita had suggested earlier, we'll do a competition analysis. So a competition one was doing an ARR of 24 crores, was raising 30 crores on a pre-money of 96, which means they were looking for a multiple of 4. Somebody was looking for a multiple of 5.78, but the industry average was 4.29 for the kind of company that today this person is come to me for. So if the market multiple is 4.29, how come this guy is asking for 8.75? Yeah. So I will ask Balaji, how will you answer this question? The market multiple is 4 and you are asking for 8.75. How will you like to justify this? Maybe
So
what
maybe
bolo.
we can bet on the founder and take that strong conviction. Maybe it can increase. That's one option. Or okay, fine, let's go with the traditional approach. Then we'll go with the available market data. Probably we can take it as multiple
Name the
5.
5 things. Name the 5 things again for my
That is
benefit.
team, market, asset. That's products were developed, traction, right? As well as the commercial and the exit for the investors.
Okay. So if those 5 things are giving you a decent enough feel, you might agree to 8.75. Another argument that you could do was, okay, sir, 1 year ago, I was doing only 12 lakhs. Today, I'm doing 1.2 crores. I'm growing at a very, very fast rate. And in future, I'm planning to do 12 crores, but in 18 months. And if I apply the market multiple of 4.29 to this 12 crores, I will get 51.48. So the company will be worth 51.48 pre-money. And today the company is worth how much? Post-money, how much is this company worth today? Post-money, how much will it be? 14.
14.
Yeah.
14,
So
yeah.
14 will become 51.48
51. Yes.
because you apply a market multiple of 4.29. Okay? Sounds good? But what can go wrong? What if the person doesn't do 12 crores? Yeah. So we as investors also do bottom of the screen, which is we apply certain discounts. What if the person makes 12 crores? Then my return is 145% IRR in 18 months. Is this clear? Is something not clear in this? Abhishek,
Yes, clear.
clear? Yeah.
Yeah.
Now, this is a model that the analyst will create. Yeah. And then discuss with the partner to say, sir, these are the possible returns. So what's the likelihood that a discount of 40 can apply? So they will go through the business plan, the projections, and they will look at the teams that are going to make it happen. So if they're saying that I'm going to go and close so many sales, then they'll want to say, please show me your CRM. How many companies are there in the pipeline for you? Or if you are a B2C kind of a company, then you will look at, what is your advertising methodology? How are you going to reach the market? Right? So you will do all of those checks. You will look at the profiles of every person in that company, and including not only the founders, but also of the next level people. Right.
Whether the investor will work with 4.29 or whether they will work below that also. Like they'll be checking like with the average rate or whether it may go down, whether they will think like that.
Yeah, I think they'll discuss, right? I mean, if you were yourself an investor, Anita, wouldn't you want to know that?
Might be certain business might be good for 3 year, but after 3 year we may not be expecting it to grow.
Yeah, what if COVID-25 happens? COVID-19 what if COVID-25 happens? So that's why equity financing is unique, because equity finance is very high risk. So the investor has already done a modeling to say, out of the 10 companies that I'm going to invest in, 8 are going to fail. And yet, my fund level return will still be 28% or 24% or 32%,
Okay,
whatever.
got it.
Okay, so that's how they do.
Yeah.
That's why our modeling is important, because they will not only evaluate you, but also look at the fund level. They have a portfolio of companies in which they are investing. Please understand the psyche of the investor. Put yourself in the office of the investor and then think. Okay? I think that this makes sense.
Yes, got it.
All right. Right. Okay. So let's look at what makes a business investable through equity, because they could be investable through debt instead of being equity, right? So let's discuss what is investable through equity. Yeah. But before I do that, let's also look at what is not investable, or less likely to be investable through equity, as the title of the slide says. Yeah. Let's evaluate. If you do not understand what is the meaning of working capital, please ask me a question. I'm assuming you do. If you don't, please ask me. It's important. Yeah. So if you require only working capital, then you are unlikely to be investable through equity. In fact, you are a fool to take equity. Let me ask you another question. Which is more expensive, debt or equity?
Equity.
Abhishek, you cannot answer. You are a CA. Bolo, Balaji, Anita.
So it totally depends upon the stage of the business, right? The initially, if at all the company doesn't make any traction, there's no point in going for that, because company is not going to survive. How it's going to bear the interest?
Listen to my question, Balaji.
Equity, ultimately it be equity.
Equity is the most expensive thing to give, to take. Okay?
Yes.
Equity money, and to give
Yes.
equity in return. Yeah?
Yes.
All right. And we'll see when we come to cap table planning. We'll see why equity is more important. Yeah. Now, if you're a single founder or a family-run business, unlikely that you will get funded. Yeah. Because if you're a single owner, then what happens is that the investor worries. What if you fall sick? To put it mildly. If the promoters are holding very low equity at the time of raising capital, that again is a problem. If you are a capex heavy business, they will say, boss, convert this capex into a lease.
That's it, like.
Lease the company. Yeah. If you are a services only company, that means you don't have a brand. So for example, if you are a recruitment company, now that's a services business. It is unlikely that you will get capital, equity. Yeah. If you negotiate your salaries with the investor, it's a problem, because cash is, you should not be fighting over cash. You should be fighting over equity. And remember, the investor doesn't want you to go down. So he will make sure that you're fairly compensated. Okay. If you create a business which has shampoos and has, let's say, medical devices, they are unaligned. So you need to have products which are aligned to each other from the perspective of the ultimate buyer of your company. Yeah, you should have all the business lines, all the product that you have, they should be aligned towards a single buyer. All right, let's look at what's investable through equity. I won't go through this. If you have a question, please ask me. Why do you think I have underlined the word defendable?
Which can be controlled.
Okay. What else?
The value created should not be poached away. So
yeah. So see, if you just have a patent, if you say that my business has a patent, that by itself is not good enough. What if your patent has not been drafted very smartly? Okay, the wordings of your patent are not good enough to give comfort that it can be defended. So it should be a defendable IP. I have also mentioned ability to attract middle management. Now, why is that important?
Scaling the business.
Yeah, sure. Ability to attract middle management, that is the let's say the non-founders. Why is that important?
Because you
See,
will
many
need
a
the
time,
right team.
sorry?
You will need the right team to execute, right?
Correct. There's another reason. And that reason is, if you say that, sir, I need to raise more money because I have to give very high salaries to people. Yeah. So then that's a problem, because you have to have the ability to convince your employees that please join me and take equity. Just like you're convincing me as an investor, yeah, to take equity and not give debt, you should also be able to convince the employee to potentially, take more of equity than debt, than salary.
ESOPs, right?
ESOPs, yeah.
You should be able to make the company sexy enough for them to join you. Just like you're convincing me, you have to be able to convince the middle management. Yeah. So there also they will go through the process of saying, sir, I have an offer from Infosys. Why should I join you? Yeah.
The people manager or stewardship.
Huh?
People manager or the stewardship, leadership, to attract
Even at the time
customers.
of, even at the point of attracting them to join you, it is important. Okay. I have also mentioned when there is clarity of exit or next round raise. So investors also not only want to know how much money you need today, but they also want to know how much money you need 18 to 24 months from now. Why do I keep mentioning 18 months, by the way? Has anybody thought about that?
Maybe we want to bring the next set of investor, or the existing investor wants an exit.
But why 18 months? Why not 9 months? Why not less? Because two things. You want to bring enough traction into the company before you raise the next round, no? Correct? And how much time does it take to raise capital? Up to 6 months it can go.
Yes.
So 18 months minus 6 months is 12 months. At the end of 12 months, you have to start the process of raising funds. And when you're raising funds, the guy will want to know how much traction have you reached in 1 year. Yeah. If you start the process of trying to raise the money within 6 months of raising the capital, then you made a mistake, because in 6 months it is hard to get good traction. Initial phase goes in hiring people, appointing them, and all of that, right? So it takes time. So think practical. All right. We're about to come to the end of my talk, but this last piece is going to take time, which is the healthy capitalization table. What is a cap table? Sahil?
So investors, all stakeholders who have the share in the company and
Correct.
different kind of rights also.
Correct. Yeah. By the way, I see only Balaji, Sahil, and Payal. Are others there, or maybe they're not in my screen? I think Gina
Yeah,
is there.
we are here. We are here.
Okay, awesome. Awesome.
Actually, I am at church. That's why I am on mute. I'm not making more conversation. Here, some programs are going on. So it will be
Okay. All right. All right. So let's go towards healthy capitalization. So, like I said, the cap table has the list of shareholders. Promoter 1 through promoter N. Sometimes there are friends and family. Sometimes there's an angel investor. Maybe Series A investor, Series B, blah, blah, blah. Maybe there's ESOP, right? So there are all kinds of shareholders in the company. I have not called out ESOP clearly, but you can say promoter 1 through promoter N. One of them is an employee 1 and employee 2 who may be holding some equity also in the company. Yeah. So I'm not going to go through that. So what I'll do is I'll copy this table at the bottom, all the names. Yeah. If you see, I've copied all the names over here. And what I've done is at the bottom, I'll put how much money is being invested. And on the top, I'll put how much number of shares and percentage of equity from there. Is that fair? Is this clear?
Yeah.
Yeah.
yes, yes.
Okay. So when you form the company, typically people put in 50,000 each. Yeah. And company law says that the first time when you create equity, the share value should be 10 rupees. It can be 100 rupees also, by the way. It doesn't have to be, but typically people choose 10 rupees as the share value. Right? So 50,000 divided by 10 rupees per share is how many shares?
5,000.
Yeah? Which means the two of them hold equal equity in the share, 50-50. Fair enough?
Yes.
Yeah. Okay. Now, let's say the person goes to their uncle or their neighbor or their ex-boss or their somebody other than an angel investor, and they say, let's say their mama is agreeing to invest some money. So so let's say you go to your mama and mama, please give me 30 lakhs. Mama is also very clever. Mama says, okay, I'll give you 30 lakhs, but I want 30% in the company. So if mama gets 30% in the company, the others will come down to
35.
no,
Yeah,
70.
35.
Total 70. 100 minus 30.
Yeah, okay. Yeah.
Yeah. And their shares will remain the same. 5,000 is 5,000,
5,000. Yeah.
5,000, but percentage has come down. So by how much? How many shares should you issue so that mama gets 30% is what has been calculated over here.
Yeah, okay.
Can you do what principle will you apply? What principle of mathematics will you apply here? Ratios and proportions, right?
Yes.
That is 10,000 shares is equal to 70%. Therefore, 30% is equal to what? That is 4286. If you do this calculation, it will come out to this number only. Does that make sense, Payal?
Yeah.
Hmm?
Yeah.
Trust me, this was done on an Excel spreadsheet, and Excel mathematics is pretty good. So The number of shares were 10,000, but 10,000 were 100% at this stage on day one. But in 6 months, they become 70%. And hence, the Mama should be issued 4,286 shares. Now, how many shares are there in the company?
14 to 8.
14,286. So
14
if
to 80.
14,286, right? So if the next round investor comes in and also asks for 30%, then all this 1426 will become 70%, and the incoming investor will be issued 6122 shares. Yeah, and so on and so forth. Just an example that I have given. Yeah. What is happening to the promoters' holding? It's going down.
Yes,
It is getting,
slowly it is decreasing. Shares are decreasing.
it's getting diluted
Is that
every
good?
every
Dilutes.
raise.
But the money will be good, right? The valuation part will be very high.
Yes.
Will be higher, but is this good enough? Could it have been higher? But have you lost control of the company in terms of the
Share.
EGM?
Angel stage, yes.
Yeah. Have you lost control of the company? Yes, you have lost.
Yes,
Is that bad?
49% total.
Yeah. At angel stage, you are becoming 49%. That's bad.
That is fair enough. I think 49 is a good.
No,
No,
it
Angels
is
not. It's not at angel
No.
stage. It's not good at all.
But major shareholders
Like,
will be.
the first,
between Series A and Series B, 49 is okay.
Yeah.
Yes, yes, that's what.
Okay. But at angel stage,
no, it is not okay. It is not okay, Amitabh. I'll tell you reason. The dilution, right? Hello.
yeah,
Yes, yes.
The dilution at the angel stage, right? Even at the front end, it's fine, I mean, because it's gone on the
Your voice is
50,
breaking,
that's
Bala.
sure, right?
no,
Equally,
Balaji,
50 to
you're breaking up.
50.
Balaji, you're breaking up. Let me do one thing. Let me actually pull up the Excel spreadsheet. Just give me a second.
The point here is we can take examples of current unicorns and understand how much they own right now, at what
Okay,
stage they have given the equity, and how much
let
they
me
have the say.
let me do one thing. Let me just pull up the Excel spreadsheet itself. Okay, here is the exact Excel spreadsheet. Do you see the screen? Should I increase the
No,
font?
we can see
Yeah.
this.
Okay, so we took the example of 50,000, 30 lakhs, 30%, and so on and so forth. If I want to maximize this, the first thing that I will attack is I will not let Mama hold 30%. I will tell him, how much should I give Mama?
Less than 10%.
Okay, so let's say we give him 8%. Spreadsheet has changed. Now 3264 looks good. Yeah, 64 looks good,
Yes,
right?
yes, yes, yes.
But I'm still below 50% at Series A.
No, in fact,
And I-
at angel, see, my take is even at angel stage, it should not be 30%.
Correct. How much
Should
should
be
I give?
around, it should be around 15 to 20%.
All right, let's give him
Less
50.
than 30. Yes.
Yeah, let's give him 50%. It's looking nice. Yeah, correct. Here also, when I'm taking 30 crores, I will still not give 30%. I'll probably give 20%. Yeah, it's more than 40% is kind of okay because the valuation of the company, if you notice, has gone up now.
Pretty
It
high.
is almost 1,000 crores.
1,000.
Yeah, and 40% of 1,000 crores is 40 crores, which is worth more than the shirt and the bicycle that the founder came to me to meet on the first day. So he will definitely not quit the company. Now he will work his ass off for the equity. Now you see the importance of why the valuation of the company needs to go up. But what if valuation is way higher than the ARR of the company. It is 100 times. Can it be 100 times ARR?
For some unicorns, it was.
Yeah,
Possible.
for some business it work, but we cannot completely
Correct.
say that.
Correct. You can't assume that. So what is the typical multiple? It is between
20.
10 to 30 max. Yeah. So what we'll do is you see another tab on my screen called cash in and cash outflows. I'm going to click on that one now. Okay. You see the screen? Cash in and out.
Yeah.
Yeah. I'm going to click on that. Let's see what does it contain. So it has balance. Like I said, whenever you're looking at an Excel spreadsheet, look at the names of the rows and look at the names of the columns. So names of the columns are very simple: period 1, period 2, or month 1, month 2, or quarter, or whatever it is. And then I start with bank balance. Yeah. I have bank balance of so much. I've not taken any investment so far. I have 0 receipts. Okay. I have operating expenses. OPEX samajhte hai na? I hope all of you understand what an OPEX is. Operating expenses.
So the bank balance has a negative numbers, right? It's overdraft.
Correct. So at the end of the first month, my bank balance has become negative. Why? Because bank balance plus investments plus receipts minus OPEX minus CAPEX is equal to the next period's opening balance. It has become negative. And it become more negative, more negative, more negative, more negative, peak negative, and then it starts to go towards positive. Why is it going towards positive? Because
Period 11.
the receipts are
They
increasing.
started, generating revenue. Yeah.
Okay, they started generating decent enough revenue, and in say period number 12, you have become cash positive. For you to turn cash positive, how much money should we be raising? You know the peak negative. So how much should you raise?
We will sum it all.
The figure is in front of you, the red cell.
1 lakh is 13951, right?
Can you read it out aloud for me, please?
13951,694.
1 crore
I-
40 lakhs.
Yeah.
So 1.4 million.
94.
694.
Yeah.
So if I put this number, what will happen to the top screen bank balance? Everything will become positive.
Positive.
0 or positive, right?
Yeah.
Am I right? So I really need to raise only 1 crore 39 lakhs 51,694. But obviously, man proposes and God disposes. So we can't
But
predict
whenever we are raising fund, we should add few more means little expected money plus few more increment. We should
How much should that be?
at least 5% minimum.
No. You must have at least 6 months of cash with you.
6 months. Okay.
At least have 6 months, 3 months to 6 months. Sometimes it is 3 months, sometimes it is 6 months. If you're a very healthy business, you should attempt to have, on the day you're going to raise the money, if you have less than 6 months, you know that it takes about 6 months. Sometimes it takes 6 months to raise money. So you must have at least
Yes,
6
yes.
months, right?
Understand. Got it.
Let's do one thing. I'm going to sum total this up to here. What is the total? It's about 2 crores 49 lakhs. You see the bottom? So say 2.5 crores, and let's round this off to 1.5. Yeah, just for the sake of argument. I'm going to make this into 4 crores. I have decent amount of money. What was previously the least amount of money? So I have at any given point in time 6 months of runway. Yeah, but let's look at this number, which the period in which we had the peak negative. Let's look at the MRR. It is around 25 lakhs. 24 lakhs 96,948. If you multiply this by 12 months, it is about 3 crores. Yeah. So your revenue was 3 crores and you are raising 4 crores on a pre-money of, let's say you are at this stage. So you're raising 4 crores on a pre-money of this much, 17 crores. Sorry, here is the pre-money value. These are all mathematics, okay? This Excel spreadsheet is available, so you can play around with this. So you are having a pre-money of 17 crores and your MRR is 25 into 12, 4 crores. Is that a fair valuation? Yeah, it can be. Right? So you need to make sure that, but what if your revenue on that day is only 1 crore and you're valuing your company at 17 crores? That could be a challenge sometimes. Unless the market multiple is showing that 17 to 20 is very normal for your kind of business. And you're very, very unique and you have a patent and you have a good understanding of the market and your traction is good and the exit opportunities are high and the team is good. Right? So there are multiple factors that the investor has to consider before they take the call to invest your money. Understood the purpose of this exercise? I'm linking how much equity you should give away to the revenue of the, or whichever is the KPI. It doesn't have to be revenue. It could be some other KPI. You can create this table by some other KPI. Yeah. And what is the pre-money at that point? This is a good insight, guys. No. Good insight?
Yes, yes.
Yes.
Yeah. Abhishek agrees,
Yes.
Payal agrees, Anita agrees.
Yes.
Balaji?
Yes. Yes.
Yeah.
All right. With that, I will pause my presentation. Or let me show you one more thing. Yeah, why don't I do this? So there are all kinds of businesses. There's a business which is enterprise based. Sometimes there are B2B SaaS business. Then you have Uber, Ola kind of businesses, which is usage based. You have Spotify, Netflix kind of a business. You have Paytm kind of a business. You have a Flipkart kind of a business. You have a Fitbit, altimeter, telematics kind of a business, or you have an advertising revenue-based business or e-commerce. So for all these companies, these are the KPIs which are important. This is available on my LinkedIn profile. Okay, so if you go to my LinkedIn profile, in fact, let's go there for a second so that you exactly know where to download this from.
Is
Right.
it possible to get the Excels too? Excel calculations?
Sorry, what? The Excel? Yeah. I'll give it to you.
Is it possible to get the Excel calculations also?
Yeah. I'll send it to
Gina, if you share with Gina, I think Gina can share
I'll
it
share
with
it.
us.
Okay, so we are on
I
my,
think that will help us.
yeah, sure. Okay, remember, you have to do this exercise only one time in your life. Okay, and then you'll become familiar. All right, now, so I'm going to scroll down to my thing until you reach featured. Once you reach featured, click on the image. Once you click on the image, you will see this maximize the screen. If you maximize the screen, then you can see the download button. Can you? Yeah. And that's how you download. And it has got everything that I told you. Yeah. Everything that I showed you, they're all here.
Okay.
Even the exercise that I did, this exercise is also here. Okay. All right, guys, let me just go back to presentation. This is what I showed you. So all kinds of KPIs are available. You should be able to actually describe your company in one sheet for the benefit of the investor. This also I will send. Gina, I'll send you this also. Get people to get in the habit of writing this.
Sure.
Term sheets. See, term sheets are usually a very long document. Maybe not very long, but I would say sometimes there are 2-page documents, and sometimes there are 20-page term sheet. Term sheet is nothing but a agreement, a soft commitment to invest in your business. So if term sheet is a soft commitment to invest in your business, what is a hard commitment? Anybody?
Can you
How do
please
you,
repeat the question?
if a term sheet, do you know what a term sheet is?
Yeah.
Okay. So if a term sheet is a non-binding transaction document, then what's a binding transaction document called?
Shareholder agreement.
SHA?
Shareholders agreement, share purchase agreement.
Yeah.
Shareholding agreement?
Yeah.
Yeah.
SHA.
Google this. Okay. Difference between shareholders and share purchase agreement. Shareholders agreement and share purchase agreement.
Okay.
So there is a
Usually-
difference between these two.
Yes. Share purchase, when you're purchasing a share, yeah, it is called an SPA only. But then there will always be a shareholders agreement, which is to account for the rights of other investors. Okay.
Yeah.
Or you proceed with the diligence. Oh yeah, let's go through the diligence. How do you diligence? So you make a pitch to the investor, they start to do business diligence on you. They will issue you a term sheet. They will take it to their investment committee, saying that, sir, I will issue this term sheet subject to your approval. Once they do that, then they will conduct financial due diligence or legal due diligence. And once that is clear, they will do shareholders, share subscription or shareholders agreement, which is the same as share purchase agreement. Okay. They will do tranching. They will not issue all the money because there will be some conditions precedent. There will be some conditions subsequent, which is that you have to complete XYZ terms before the money is issued to you. And then they will help you in raising the next fund or get an exit. Or if you're not done well, then close the company down. Yeah. Okay. Let me also show you how does a fund work. How does a fund work? You are the guys in the gray pockets at the bottom. You are the investee companies. Then there are these blue guys who are the investors to the fund. Yeah. Then there are two people on the right hand side, the trustee of the fund and the auditor of the fund. Why do we need trustee and an auditor? To make who happy? Will they make you happy or the investors happy?
Investors, they're the custodians for those funds.
Correct. Yeah. Then why do I need an investment manager outside of the trust? Because a trust is just a bank account. It is not a company. A trust is the control of the trust rests with the trustee. So you have to be outside of it. You can't be inside it. So the investment fund, so July Ventures Fund LLP is the one on the left hand side. Yeah, they have their GPs, general partners. They have their employees. They're all sitting over here. Yeah, and then they have an investment committee and they have some advisors. Yeah. So for managing, so the investment manager will decide to invest money in this particular company and will ask the investors to draw down the money. Sir, a new company has come to me that requires 10 crores. So you, sir, in the proportion of your investment in the fund, please send me that much money. 10 crores multiplied by the proportion of holding in the fund. That's what they will invest. Why is this important for you to know? Why should you know what a fund looks like? Take a guess. There is no right, there's no wrong answer, guys. Tell me, why is it important for you to know? How long is the fund, by the way? Is a fund for life or fund has a duration?
So it's very important for you to know what sector or fund means the fund is into what sector and how well they are connected into that specific thing. So from a growth point of view, it's very, very useful to have the alignment with your investors.
Absolutely right. Any other suggestions?
It's a
Abhishek?
long-term relationship.
Yes. Also, I mentioned something called as the period of the fund. Yeah. Usually there is a period of the fund. So it is a 7-year or an 8-year fund. Yeah. Let's say you come in, you go to the investor in the very first year of their launch. Is that good or is that bad?
Good.
Why is it good?
Because initial, right, you'll more opportunity to get invested in the business.
Yeah. And they are under pressure to deploy. No, they are not under pressure to deploy. In the first year, they are not under pressure to deploy. In the fourth year, they are under pressure to deploy because now very less time is left. So you don't want to go to an investor in the last year of their investment. As much as you can avoid, it is better. And that's why investors try to deploy the money in 2.5 to 3 years and not wait for the fourth year. Because there's at the end of the 8th year, they have to return the money or give your shares to them. So please understand the dynamics of a fund. How does a venture capital fund work in India? Google this, sorry, YouTube this, don't Google this. By the way, that's one of my way of doing search. I have stopped going to Google first. I first go to YouTube and then pause the video and then do a Google.
I have another doubt.
Yes, Sarita.
If we suppose we have enough fund, but for having a better team, for example, if some institutions comes into the company, it will grow in a more better way. So
Yeah.
in that, it's not purely for the fund. At that case, is it how the equities and holdings can be calculated?
Beautiful, beautiful. Very nice, Sarita. So whenever you're going to raise the fund, just put yourself as if you're going to have one of your children married off through an arranged marriage in the market. Will you not go and do a due diligence on the would-be in-laws?
Yes, we will do it.
Correct? You'll want
Yes.
to know how many people are there. Yeah, what is their income? Yeah, how will I be very proud to give not, I don't want to be very sexist here, but let's say, will I be proud to have them as my in-laws? Yeah. And do they already have, yeah, one of their sons or daughter has already been married, and it's a very different kind of, they believe in caste system, for example, and you are not from the same caste. Will you go? Is there any point in going to an investor where they have a consideration for caste and you're not from the same caste? It doesn't make sense.
Okay, understand.
Okay, so you have to study your investor. Read
Great
their
ex-
website very, very
Great,
carefully.
great example.
Hmm? Because it is true. See, it's like getting married. For a period of 7 to 8 years, you're going to get married. They are going to get married to you. Yeah. So when two people get married to each other, can it start with distrust? It cannot. Can you be unfaithful to your partner? You can be, but then you'll pay the price for being unfaithful, right? So the investor will not be cruel to you. You can take it. Good investors, mature investors will always give you a fair deal. If they give you an unfair deal, what happens? We go back to the cap table. The cap table will become lopsided, right? The investor taking too much equity is bad, right? We've discussed that. So it's important to know
Yes.
how a fund works. I think I'm done with my presentation.
Any further queries, Balaji, Sahil, Abhishek?
Questions?
Any terms, any slides you want to go through? Is it fine?
Yeah, it was good.
Yeah.
It is very simple and interesting, and that the practical concepts were explained in a very interesting manner. Thanks, Amitabh. Sunday well spent, I would say.
Thank you so much, Amitabh.
Thank you.
Yeah.
Thank you.
Thank you very much,
Good insight.
Amitabh.
Hold on. Just let me see you guys. All of you, can you please turn your video on if you don't mind? Let me stop sharing so that I can see you at least. Yeah. Looks like Payal doesn't want me to show her face.
No, it's just a Sunday morning, right? So maybe I'm not very.
Look at me, I have the t-shirt, my nightie still.
All oily face we have, but it's okay.
Yeah, so I even have not taken a bath. I just realized at 10 o'clock that I have to be on this call at 10:30. So,
But
I know.
thanks a
Anyway.
lot, Amitabh. It was very useful. Actually,
Good.
I've seen this presentation as you asked me the last time, right? Go and check it out.
Yeah.
Yes.
But it's the explanation which is important,
Which makes
right?
it.
Similarly, when you go to make a presentation, have very few words on the screen and talk more.
Correct.
Yeah. And actually script. See, you know what I do? I say, let's say, typically what's good to have is 6 to 7 slides to describe your business, then have a thank you slide, and then after that have appendix 1, appendix 2, appendix 3. So if a question is asked which is not answered in the 6 slides, then you go to the appendix. Don't go to the appendix because your objective in that meeting is to be called for the next meeting. In every sales, this is the fundamentals of sales. Okay, you want to be called to the next meeting. That is your key objective. Yeah. If it is the first meeting, of course, you don't want to keep being called for the 15th meeting. then something is wrong. But yeah. Okay. I'm glad that you found this useful. Gina,
Yes,
was it
yes.
okay?
Yeah, we are okay. So, yeah.
Yeah. All right. Thank you, guys. Thank you very much. Have a good
Thank you,
day.
Amitabh.
Amitabh, I
Okay.
will
Very
reach
much,
out to you
Amitabh.
for further insights.
Sure.
So I was just comparing FunGrow at each and every slide. Where do we stand? How does means we have implied what you are talking about in our
Yeah, this is really a bad time, but I'll try and give you as much time, or I'll get you in touch with somebody who will help you.
yeah, that will help you. Thank
Okay,
you.
guys. Have a good day.
Thank you.
Thank you very much, Amitabh.
Thank
Thank you
you.
very much,
Thank
Gina.